The UK stock market has pretty much underperformed every other market in the world over the last 10 or 15 years. And if you go online, all you'll see is people saying that the UK is uninvestable, you only have to be in the US, the UK is underperformed, don't invest there. But in my own portfolio, I've got about a 10% weighting to the UK through a specific UK actively managed fund. And I think it offers something different, and it's quite an exciting opportunity at the moment, especially with everything going on in the US with Trump and the markets down and all that stuff. So that's what we're going to talk about in today's video: why I invest in the UK, the opportunities that I see there and how it benefits my portfolio. And then, that should give you some ideas about how potentially you could think about using the UK in your own portfolio. For the last 12, well, really, I was going to say 12 months, but even 5 years, the UK has been on significant outflows. People are moving money out of the UK into the rest of the world, but I think there's reason for that to change, and that's really what we're going to break down in today's video. So then, in terms of the structure of the video, I'm first going to talk about valuations and why the UK is quite cheap at the moment. I'm then going to come on to talk about why the UK market is quite different to everything else that's out there and how it provides that diversification benefit. And then finally, I'm going to come on to talk about the exact fund that I use and why I've selected that fund for my portfolio. But before we get into the bulk of the video, I just want to remind everyone that this is not financial advice. This video is for education and entertainment purposes only. So with that said, we'll come on to the UK market and the valuation side. So starting then with valuations. And if you watched my previous video, you'll know I quite like a ketchup bottle analogy for stock market returns. So think about a ketchup bottle. It's full of ketchup. Ketchup is the stock market returns. It can all come out at once, so you can just pour it all out. You can have it sort of steadily going across the sandwich, I guess. Or you can try and get it all out, nothing comes out, and then it all comes out at the end. And that's sort of what happened with stock markets. So again, if we think about the US, we've had a ton of returns. So you can think about that ketchup bottle potentially being empty, and now you're sort of left holding the bottle. But when we come to the UK, the valuations are pretty much as low as they've ever been. And what that means in our analogy is the ketchup bottle is basically full of returns, or at least it could be perceived that way. So typically the UK is known as like a value market, so quite a cheap market. It has a sort of 3-ish% dividend yield on average, but at the moment that's 4%, and the companies are buying back a load of their shares. So breaking that down, what that effectively means is the companies are distributing to the shareholders about 6% per year, just under, through dividends and buybacks. So that's after all of their wages have been paid, taxes, they've grown their operations, they've built the factories, they've then got this free money to deliver to shareholders however they want to. And that level is about 6% or just under for the UK. I think in Europe it's like 3, maybe 3.5. In the US it's 2 or less. So you've got that big buffer on the valuation side. So that's the first thing that I think is attractive about the UK market. The second thing is offering something different. So again, if you think of the US market, the first things that will come to mind is tech, growth, all the interesting stuff, Microsoft, Nvidia. If you think about Europe, I mean, you might not know much, but the first thing, the things at the top of the index are pharmaceutical companies. They are the luxury designer brands, all of these high sort of premium stocks that are typically more expensive, but they're more volatile. Whereas if you look at the UK, a lot of the UK stock market, not necessarily the economy because they're not directly linked, but the UK stock market is very differentiated. So the top 10 is a lot of banks. There aren't many banks in the other two indexes top 10, if any. There's tobacco companies, that stable cash flow. People are addicted. If there's a recession, they're still going to buy the tobacco. Tobacco companies don't appear in either of the others top 10. You've also got some pharmaceuticals as well, but you've also got oil and gas. I think just on the pharmaceuticals point, AstraZeneca I think is the number 1 holding in the the UK tracker. But yeah, we've got oil companies as well, which the other two also don't have. So again, that's sort of built in inflation protection. So in 2022, when we had that big inflationary spike, the UK market was the only market that actually performed well. And a lot of that is to do with the oil and gas companies. So again, in the last 10 years, it's been all about tech. It's been all about growth. And now you're seeing the tide start to shift. I think tech's probably down 10% in the last week because of Trump, whereas the UK is down actually quite a lot, but the UK is down less, and it's less sensitive to this sort of uncertainty, this dynamic that's going on in the world right now. And that's where the diversification point comes in, and that's why I've got only a 10% weighting in the UK, but it helps in sort of insulating the broader portfolio. So then coming on to the fund itself, the one I use in my own portfolio, I've got my laptop in front of me. So we've got TrustNet up, one of my favorite websites to look at different funds. And you can see it's called Fidelity Special Situation. So Fidelity, you probably would have heard of, huge US asset manager, and they've got a really strong UK team, which we'll come on to when we see the managers. But yeah, I feel more than happy with Fidelity. Someone like Fidelity running my money. You know, they've got a huge bank of resource, loads of analysts, all of the contacts they would ever want in any company, geopolitical experts, economists, whatever you want. Basically, Fidelity have got it. So that's the first tick in the box. We scroll down here, we'll come on to performance. Now, the 5-year chart now has dropped the COVID crash off, so it's somewhat skewed because you can't see how it performs in a downside market. But, you know, I can't really do much about that. It's just the page how it is. So looking at the 5-year, you can see performance has been very strong over the UK market. And that comes down to the selection of stocks that the managers have been doing. I think the guys there, let's just scroll down quickly so I can see. Yeah, Alex Wright is a super famous, super well-known UK investor. He's been the manager since 2014. So you can see he's got 23 years of investment experience. So this whole sort of Fidelity UK team, I'm super happy with. And their performance across a load of different funds that they have. They also have a UK smaller companies fund, has been really good. So I'm more than happy to hold this fund. So coming down onto the ratio information and the fund managers, I'll start with the fund managers as I just mentioned them above. Alex Wright is super well known across the fund management industry. He's been manager for over 10 years now, super experienced, super strong performance. And this fund sits within sort of a broader UK area for Fidelity. So they've got an investment trust, they've got this fund, they've got a UK smaller companies fund, and then they've got, I think maybe one more, or maybe that's it. But yeah, they're super knowledgeable about the UK market, lots of experience, so super happy with that. And then the ratio information, 1 and 2 basically means you're the highest in the sector, 3 and 4 means you're lower in the sector. You can see that alpha is a good statistic to look at, an information ratio, which those two effectively mean the excess performance they're generating for the risk they're taking on. So the higher that is, the better. They're generating more return for the risk they're taking on. So all good stuff there. And then as we come down onto the unit information and the fund information, you can see the fund size is just over £3 billion, which is on the larger side, but when they're investing in large cap UK companies, not an issue whatsoever, no liquidity problems there. The other thing to highlight is the OCF, which is the charge that you'll pay as an investor to Fidelity effectively, and that's 0.92% per year. And that's quite high for any fund really, any active global equity any active equity fund, especially in the UK. But again, you're getting access to this resource, the performance is great, and the managers are super experienced. So it's a bit of a premium price, but I'm happy to pay that, and the performance has been worth it. So then we come down to the breakdown itself. The asset class breakdown on the left, you can see 86% in the UK, and then some miscellaneous stuff in Europe where they see really good opportunities. I think they've probably got a 20% mandate to go elsewhere, so that can go as low as 80% in the UK, but they've got it at 86% for now. But the more interesting side is the top 10. So I was just going to run through a couple of these just for example's sake. Standard Chartered, NatWest are banks. So big on banks at the moment. The UK economy, despite the headlines, is relatively okay in terms of bank repayments and mortgages and all that stuff. There's no crisis at the moment. And effectively how banks work is, I'm not going to get into how banks work, but higher interest rates, are beneficial for banks, and with higher interest rates that we've got recently, their profitability should be quite strong for years to come. I'm actually going to do a deep dive on banks at some point, a video on banks, because I quite like banks. So yeah, I'll leave that for them. Imperial Brands and British American Tobacco, like I said, the tobacco companies are super stable. The cash flows are really high because it's quite cheap to make cigarettes, and they've got a very loyal customer base. So that's just cash flow machines, paying high dividends, buying back the shares, as I mentioned earlier. So they're both in the top 10. Got some insurance, which I did a video on. I think AIB might be insurance as well, but I'm not actually sure. But you can see Direct Line is in there. And again, If you watch my insurance video, you'll understand that Buffett loves insurance. With interest rates where they are, super attractive at this point in time. So it's not a surprise that you'll see insurance up there. But the gist here, and what they're really trying to target, is high dividends, high returns to investors, buybacks and cash flows. And that you get a lot of that in the UK market. Whereas in the US, you get a lot of growth, so a lot of reinvestment, no dividends really. There is a bit, but not much. It's all about reinvesting, growing the company, expanding your products, all this stuff. In the UK, a lot of these companies are established already. There aren't too many growth opportunities. So in some ways, it makes it a lot more boring, but it also makes it a lot more stable and a lot more friendly towards dividend payments and buybacks. And that's why I think it offers something different, and that's why it's in my portfolio. So that was a whistle-stop tour of the UK equity market and a certain UK fund. And it brings us to the end of the video. So if you enjoyed, please leave a like, subscribe, and I'll see you in the next one.